Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. With the bond market and other traditional signals indicating that a recession is almost imminent, what is a fixed income investor to do? Joining us to discuss, we have Kurt Halvorson, portfolio manager at Western Asset Management. Kurt, it's great to have you with us. Welcome to Trade Talks.
Hey, Jill, thank you so much for having me.
You got it. And one of the many things puzzling investors about today's financial markets is the disparity between the high level of uncertainty about the future path of the global economy and the resilience of risk asset prices. So with the bond market and other traditional signals indicating that a recession is almost imminent, what is a fixed income investor to do?
Sure, that's a great question. And honestly, the answer to that is to really look back at what happened last year in terms of the Fed and the work that they did in repricing the bond market. And so what we've seen is a major change in valuations from January of 2022 until now. We've seen a dramatic increase in yields. And so that has really restored value into the fixed income sector. And so we feel that as the Fed is getting close to the end of this tightening cycle, that investors will start to return to the fixed income market as the valuations have become really attractive. And we think that the risk reward there is very compelling.
The fundamentals for investor grade credit remain very strong, perhaps stronger than at any previous time of uncertainty like we're seeing today. Why do you think that is?
The simple answer there is management teams. Most of the management teams at major corporations in America have been in that seat for quite some time. And if you think back over the last 15 years, we've had two major events, right? There was the global financial crisis, obviously in 2008, and then the COVID shock of 2020. And these management teams, they have good memories. And so they remember what it felt like to go through both of those experiences, and they don't want to feel like that again. And so they operate their businesses in a much more conservative way. And so we see, the fundamentals for these companies really holding up well, despite some challenges over the last 12 months, the big increase in interest rates, et cetera. They've handled these extremely well. And that's because they run their businesses in a more conservative way. And so what you see in the investment grade credit market now is some very attractive yield with lower risk than we've had before in times of uncertainty like this.
What sectors within investment grade credit should investors be maintaining or adding exposure to?
So we've been steering our clients towards large cap banks. And I think it's really important for investors to keep in mind here, when you look at the US banking sector, it's really comprised of two separate systems. So you have the large cap banks and then the regional banks. And while they do look the same from a distance, from an investor's perspective, they're very different. The capital requirements of the large banks are significantly higher. The deposits are much stickier. There's just a lot of differences here that make them two different investment classes. And we've seen this year, some vulnerabilities in the regional banking sector, and some of those balance sheets that were not set up in a defensive way, were exposed, and that caused some real damage in the sector. But as far as the large cap banks go, they're set up very well. Their balance sheets are extremely strong. Their business models are low risk, well entrenched, and they're very profitable. So we've been pointing investors towards the large cap banks, given how much spread you can pick up versus industrial. So that's the main sector that we like. And then the second one I'd point to is energy. And the energy space is an interesting one because despite the rise in commodity prices last year, we saw extreme discipline from management teams in terms of production. And so they did not go out and leverage up their balance sheet to try to increase revenue, et cetera. They stayed very disciplined to their capital plan. They paid down debt, reduce leverage, et cetera. So we really like that kind of balance sheet discipline. We still think that sector offers a lot of value.
You mentioned that the belly of the maturity curve is the most attractive spot for investors. How does it help protect against unnecessary duration risk within the credit space?
This is another unique thing that the fixed income market is offering to investors right now. The shape of the yield curve with the inversion makes the belly of the curve the most attractive. It offers a lot of yield and doesn't require investors to go out the maturity curve seeking yield. So a lot of times in a steep yield curve environment, investors will tend to extend 15, 20, even up to 30 years to try to pick up extra yield. But in the case of the current environment, you don't have to do that. So you can stay in kind of the 5 to 10 year maturity space, optimize the yield of the portfolio without having to go and buy long duration bonds to pick up that yield. So it really is a nice risk reward place for investors to be.
All right, Kurt, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.